Hello everybody. This morning I'm going to discuss, exactly like last week, the possibility of a major breakout on the Stoxx 600 index, so on European stock market indices. But this time I will focus on sector allocation. So the impact, why a breakout on the Stoxx 600 above 20-year resistance line, 19 years to be precise, would probably imply a major sector rotation. So towards possibly financials and out of defensive sectors like food and beverage, which has already started, by the way, over the last few months. Then we will also make an update on the impact of a major breakout on the Stoxx 600, of the Stoxx 600 on bond market. So if we look at a daily chart of the Stoxx 600 index, as you can see this week, we can obviously see a significant technical breakout. So from a daily point of view, the European stock market, as represented by the Stoxx 600 index, has already made a breakout. So a major upside breakout above the upper part of a multi-month trading range. So from a technical perspective, this is obviously a bullish technical event. If we look at the long-term chart I already showed you last week, the breakout needs to be confirmed from a long-term point of view. As you can see, the index has not yet clearly broken the major resistance line which has been in place since the year 2000, so 19 years. We can see that there is a much higher probability to break above this trend line. So which means that we could be at the beginning of a significant uptrend on Euro Stoxx 50 after a 20-year bear market. This is an index without dividends. If you add dividend to this index, of course the index is much stronger. But ex-dividend, we have been in the bear market since the year 2000. If we have, let's say we have a breakout next year on the Stoxx 600 or at the end of this year, why would we have a breakout? What could be the implication on sector allocation? I think we have already the beginning of an answer on what happened over the last 2 months on sectors. I think that a major breakout on the European equity markets will be probably driven by a rating of financial sectors and possibly of profit taking, so reduce lower bullish sentiment on defensive sectors. So the weakest, one of the weakest indices in Europe, banks. This is the chart here. So on the upper part you have the Stoxx Banks index. This is the total return index in absolute terms, and the lower chart is a relative performance of the Stoxx Banks total return index versus the Stoxx 600 index. So as you can see here, at this stage we cannot say the bank sector is the leading sector. Its relative performance remains bearish in the long term, and it's still trading below its declining 200-day moving average, which is this curve. Anyway, we can see that over the last 2 months, the sector has not made new relative lows. So we are starting to see a small bottoming process, and in absolute terms, the index is just breaking above its 200-day moving average and also validated a kind of irregular reverse head and shoulder pattern. So even though it's too early to call for the start of a bull market on the banks, especially relative to Stoxx 600, we can see that the market, this sector is starting to move, is starting to, selling pressure is easing. And from a technical point of view, I would say it's extremely similar to what we saw in May. So this was this period, also reverse head and shoulder. A technical breakout above the 200-day moving average, so this was the May period. But what we can see is that the technical bounce was false. So we had a bull trap, an amazing bull trap, I would say, with the relative chart encountering resistance near its declining 200-day moving average. So the risk right now is to have a similar pattern Markets regaining confidence, starting to buy banks again, and the risk is there. Obviously, in the short term, false breakout followed by renewed strength. Technically speaking, I would say I would favor, however, a stronger technical bounce. For me, the breakout on the Stoxx 600 and the re-rating of banks is the same story. So it will be quite interesting to see in the short term if the breakout is confirmed on Stoxx 600 and if we have contained setbacks on the bank sector. If we start to see the bank sector is a false breakout and Stoxx 600 is also making a false breakout, then it will be time to be cautious again on European markets. But anyway, I think in the long term we are going to have the start of a rating on banks and possibly a significant upside breakout coming on Stoxx 600. On food and beverage, we can see exactly the reverse. A very strong sector since last year, but as you can see here, panic buying over the summer, then very strong de-rating on the relative chart of Stoxx food and beverage versus Stoxx 600. So the risk here on the food and beverage sector is to have some roller coasters, I would say. So panic buying, then panic selling, then after that possibly a technical bounce of the sector, which would mean if we start to see a technical bounce of food and beverage relative to the market, it would mean probably that we have a full short-term breakout on the Stoxx 600 and that we are going to spend more time on this index around 400. If you want to compare the current situation with one in the past, I would say the risk is to have a similar pattern than in H1 2016 with the first boom burst, and after that stabilization of the relative performance and possibly even another spike. Which means that in this case, the breakout of the Stoxx 600 could be delayed by a few months. But anyway, I think the big story is that the food and beverage sector potentially made a major relative high during the summer, possibly an important low on banks also during the summer, and start of sector adjustment in coming months. A third sector I would like to show you, which is between banks and food and beverage. This is the oil and gas sector. I find this sector quite interesting right now, not because it is bullish, it is not actually. The relative performance versus the Stoxx 600 is obviously bearish, but we are starting to see a slight bottoming process on the sector, which reminds me what the sector made in, for example, at the middle of the year 2017 or in mid 2015, for example. So possibility of a technical bounce in the near term on the oil and gas sector. Last chart I wanted to show you is the same one than last week, German 10-year bond yields. You can see that the clue, a big part of the clue is also on bond markets regarding the possibility of a breakout on the Stoxx 600. The German bond market made a significant trend reversal over the last 2 months. So we are starting to see bond yields going a bit higher after excess during the summer. So it's possibly exactly like the food and beverage sector that we have seen a major top over the summer on German bond yields. So if that's the case, I don't think we are going to retest the lows hit in August. For me, the best case scenario for German bond markets would be a pullback near minus 0.60, so around this level, which is now a very important support. But longer term, I think we are more likely to extend the rally to the next important support zone, resistance zone, so on bond yields, which is between minus 0.20 and minus 0.15. So overall, topish pattern on German bond yields, topish view on food and beverage. So although we may see some intermediate technical bounces on bonds on food and beverage, but I think the big story is starting to turn. So the big trend is starting to change. Thank you very much for your attention and have a great weekend.